Yes, so the question wants us in this case to prepare a consolidated statement of cash flows for the year ended 30th of September 2018 using the indirect method in conformity with the requirements of international accounting standards regarding what cash flows. So, of course, you've actually been given consolidated financial statements. That simply means in this case, those are financial statements of our group, whereby in this case, we have the comprehensive income statement, we have the statement of changes in equity, then you have in this case, the statement of financial position. Then you've actually been given some additional information. So if you look at, in this case, the consolidated comprehensive income statement, you've actually been told there's revenue, there's cost of sales, there's gross profit, other income. So that is selling and distribution, administration expenses, finance cost. So of course, this is one of the items that, of course, it will end up having to appear in the cash flow. Share of profit from the joint venture. So also that item, we need to deal with it. Income tax expense. So that will help us in having to come up with the amounts that are actually paid for income tax purposes. Other comprehensive income, we have a revaluation gain of 105. Then profit for the year. So it has been, some of it has actually gone to the parent. The other one has actually gone to the non-controlling interest. You've been given, in this case, the statement of financial position. So, of course, you have the non-current assets. Then you have, in this case, current assets. So the current assets, in this case, will actually help us in having to look at the changes in the working capital items, changes in the working capital items. We have the equities. So the equities are simply financing activities. So those will be of so much concern when you're looking at financing activities. We have the non-current liabilities. And of course, you have, in this case, the current liabilities. Then now you've actually been given the statement of changes in equity. So that basically will be of so much concern when you're having to look at what items that are having to change regarding towards the financing activities. So of course, you have, in this case, the additional information. You are told the property, plant, and equipment account comprised of the following transactions. So there's the cost of the items, accumulated depreciation at the start of the year, and of course, at the end of it, then we've actually been given the carrying amount. So you're told during the year ended 30th of September 2018, an 80% owned subsidiary revalued its property upwards by 150 million. The holding company disposed of an item of plant which had cost 290 million and had accumulated depreciation of shillings 96 million. The disposal proceeds amounted to 215 million. So of course, in this case, when you're talking about investing activities, when you're talking about, in this case, the operating activities, under the operating activities, in this case, we talk about depreciation. We talk about depreciation that was charged during the year. Then, of course, in this case, under investing activities, we talk about, for example, disposal of assets, or maybe acquisition of assets. So it means this particular note here will basically helping us to get whether there was any amount received on disposal, or there was actually any acquisition that was actually done regarding assets, or amount that was actually spent to acquire assets. So we'll be able to know whether, in this case, any investing activities or operating activities with regard to depreciation were actually affected during that particular financial year, because they are part of the items that, in this case, we said you'll end up having to consider when you are preparing the Hello. So I don't know whether I'm back. So kindly confirm whether I'm back. I think there was a problem with the mic. So confirm whether it is now okay. Confirm whether it is now okay. Confirm whether it is now okay. Yes, I can see Ruth says it is okay. It is okay. So you're having to say this note number 1 will likely help us in having to look at those items regarding investing activities of acquisition or disposal of assets, then also depreciation. Then note number 2, there was a 10% convertible loan stock that was convertible at any time at the holder's option into 20 ordinary shares of 10 shillings each for every 200 of the loan stock. Then during the year ended 30th of September 2018, holders 180 million of 10% convertible loan stock exercised their conversion option. So of course that will be able to say it will likely be dealt. It means in this case, there were more people having to acquire the shares of the company. There was more acquisition of the shares of the company. So that means they converted the loan stock into what? Into shares. It is known as what? Conversion of interest in the company, from having to be a loan to having to be what? Shares. So that is what they actually exercised there. And of course, you'll be able to see how it will be treated. Then impairment loss on goodwill and depreciation for the year ended 30th of September 2018 have been charged in the profit or loss for the year. So of course, in this case, if you look at our format, if you just go and actually look at the format of, in this case, our group cash flow statement, under the operating activities, so the non-cash items, there's what? Impairment and depreciation. So it means in this case, what we're having to be told by that note, we have to consider them as part of the items we'll be able to adjust when you are dealing with what? Non-cash items under operational activities. So any impairment, we must actually be able to, in this case, do what? Eliminate it as part of what? Maybe the outflows. Any depreciation, we must actually be able to eliminate it as part of what? The outflows. So we'll end up having to add them back under the operating activities. So that is what in this case they mean by that pattern. Then assume the corporate tax is actually 30%. So you're in this case required to end up having to prepare a group cash flow statement, a group cash flow statement. So in most of the instances in cash flow questions, rarely in this case, you'll end up having to miss matters regarding property, plant, and equipment, either an acquisition or a disposal. So it is for you in this case to be able to know if there were some proceeds on disposal, where do I put them? If I want to know, for example, in this case, whether there was any extra acquisition of an asset during the year, it means I have to prepare what? The property, plant, and equipment what? Account, PPE account. So the balancing figure there will likely end up having to be what? Be the acquisition during the year. It will be the acquisition during the year. So whenever you see they're talking about property, plant, and equipment, there are these two key things they're having to look for you to be able to get to see. Probably there'll be a disposal of an asset. Also, probably in this case, they want you to prepare the property, plant, and equipment account, so that through this account, you can actually be able to know the cash that was spent to acquire an asset, which means in this case, it will be part of the items you'll be able to adjust whenever in this case you're looking at what? Investment activities. So it means the cash received on disposal will be inflow. Then in this case, the amount that was spent, for example, to acquire any extra asset will be an outflow under what? Investing activities. So when you see that language, there was a property that was done this like this, you won't end up having to miss to prepare what? A PPE account. And of course, from that, they'll also be able to include this just to complicate it a bit, to say that in this case, there were some assets which were disposed, so like that. So that means you'll end up having to look at whether there was actually a gain. When you see this case, they're talking about an asset was disposed. They want you to get this gain on disposal, or they want you in this case to get what? Loss on disposal. These are the key things that the examiner is looking for here. So there's this you have to determine, and of course the cash spent in having to acquire any extra assets during the year. Or maybe in this case, there was what? Maybe a revaluation or something that actually happened. To add on that, there was cash received when they disposed. So of course, if you look at, in this case, the group cash flow statement format, there's somewhere we talk about this gain on disposal of an asset, loss on disposal of an asset. So this, we have to do what? Adjust. We have to adjust under the operating activities. So when you see this language of disposing, you won't miss out to compute to get what? Gain on disposal or loss on disposal. So that is what in this case they want to end up having to do what? To determine. So of course we can now in this case start with the hello, hello, hello. What about now? You can see it is back. I think it should be back. It's in there. The sound is lost again. It is back. So we're having to say we can start with the workings. So we'll start by having to prepare the property, plant, and equipment account. The property, plant, and equipment account. So if you look at note number 1, you've actually been given the breakdown of the property, plant, and equipment, which in this case, you can see the carrying amount is 2831 by the end of the year. And of course, 2345 by the start of the year. So those are the figures that you can be able to see in the consolidated statement of financial position. Those are the figures you can actually be able to see in what? In the consolidated statement of financial position. The carrying amount simply means is what? It is the net book value that was actually there by the end of the year after adjusting what? Depreciation. After adjusting, in this case, what? Depreciation. And therefore, if you look at that note number 1, the opening balance for the property, plant, and equipment, so of course, we'll have the balance brought down. We'll have the balance brought down. So the balance brought down. So balance brought down. It is in this case 2970. Then we have the balance carried down at the end of the year. Balance carried down at the end of the year. It is actually in this case how much? 3765. So that is as per note number 1. That is as per note number 1. That is as per note number 1. So that's what you can be able to see regarding what the cost there. Then if you look at the additional information, you've actually been told that during the year ended 30th of September 2018, an 80% owned subsidiary revalued its property upwards by 150 million. So it means in this case, when you revalue, the assets go up. So there was a revaluation, so they go up. So therefore you debit. There was a revaluation of, in this case, 150 million. 150 million. But still the same case, they also did some disposal. So they disposed. There was a disposal of an asset. And of course, in the property, plant, and equipment account, you are basically having to remove what? The disposal at costs. The disposal at cost. So the holding company disposed of an item of plant which had cost 290 million. 290 million. 290 million. 290 million. 290 million. So of course, those are the items having to do what? Affect property, plant, and actually what? Equipment. Those are the items affecting what? Property, plant, and equipment. So the balance carried down, it is 3765. 3765. 3765. So it means in this case, you look at the side that in this case is actually more. In most of the instances, you'll find this one is more, so that we can be able to get what? The acquisition, any acquisition that was actually done during the year. So in this case, if you add these ones, what do you get? So 290 plus 3765. 290 plus 3765. 290 plus 3765. 4055. you get 40, 55, 40, 55. So there'll be a balancing figure here. There'll be a balancing figure here, which means in this case, this one will be the acquisition of assets, additional assets during the year. There'll be a balancing figure here. The balancing figure is at 935. So 935. It means this was what? Acquisition of extra assets during this year. So it means when you'll be coming up with the statement of cash flow, under investment activities, you'll be able to indicate there were additional assets acquired. Because in this case, if you look at the group cash flow statement format that we had, and in fact, I know you can be able to see it if you basically have your book. You look at there, there's a place you're having to say under investing activities, acquisition of assets. It means this figure will be able to go there. And of course, that's how you end up having to get it. That's how you end up having to get it. So whenever you see they have started talking about property, plant, and equipment, actually, probably this is the major figure they want you to be able to get. If there were any extra acquisitions during there, which will end up having to be what? The balancing figure in the property, plant, and actually what? Equipment. Property, plant, and actually what? Equipment. And therefore, also, if they have talked about disposal, so you can in this case also get whether there was actually a gain on disposal or there was no any what? Gain on disposal. Gain on disposal. But maybe before we look at that gain on disposal, we can do working number 2. We can actually do working number 2. So of course, maybe you can start with disposal, disposal account. You can start with disposal account, disposal account, disposal account, disposal account. So our figures are just in shillings of millions. Our figures are just in shillings of millions, shillings of millions. So of course, we normally debit the costs. We normally in this case do what? Debit the costs, this one. We'll debit the cost here, which in this case is 290 million. Then of course, in this case, you have the proceeds. The proceeds, when they sold this asset, the proceeds you've actually been told in note number 1. The holding company disposed of an item of plant which had cost 290 million and had accumulated depreciation of 96. The disposal proceeds were actually 215 million. So this one, they sold it at 215 million. Then there was an accumulated depreciation. Accumulated depreciation of, in this case, how much? 96. So 96. So you'll realize that in this case, this side is actually more. So if this side is more, was it a gain on disposal or a loss on disposal? If this side is more, is it a gain on disposal or a loss on disposal? It is a gain. It is a gain. So if the balancing figure is this side, it is a gain on disposal. So therefore, in this case, this one was actually 311. So the total here is 311. So the balancing figure is actually what? A gain on disposal. Gain on is a gain on disposal, which in this case is a figure of 21. Is it 21? Yes, 21. 21. And of course, now in this case, if you look at under the operating activities, the non-cash items, I think this one ends up having to appear there. Gain on disposal or loss on disposal. It means it will go there. It will actually end up having to go there. It will actually end up having to go there. It will actually end up having to go there as part of the items. It will likely go there as part of the items. As part of the items. As part of the items. So that is actually very important. You take note of that. You take note of that. It is actually 21. It is actually a gain on disposal. Gain on disposal. So that is what will likely end up having to happen there. So we can continue. So of course, there are issues about what? Depreciation. The issues about what? Depreciation. So of course, in this case, you have the accumulated depreciation at the start of the year and at the end of the year. So part of the plant or items were actually disposed of. So in this case, we normally do what? Eliminate that what? Depreciation. So that in this case, you can be able to know overall during the year, how much was in this case, what? The depreciation during the year. So in this case, we can come up with the accumulated depreciation account. Accumulated depreciation account. We can come up with the accumulated depreciation account. So of course, you've actually been given the balance brought down. So the balance brought down in this case, if you look at note number 1, it is there. It's just there. The balance brought down is actually in this case So our figures are in shillings of millions. So our figures are in shillings of millions. So they are not chapatis, but they are shillings. So in this case, we have balance, wrote down, of in this case, of an amount of 625. 625. Then you have in this case the balance carried down at the end of the year. It will come this side. So you know how the accounts normally operate. So the balance brought down in the accumulated depreciation, the balancing figure, the balance brought down is normally on the credit side. Then it will come this side at the end of the year. So at the end of the day, in this case, we have 934. 934. 934. 934. But remember, this depreciation accumulated in the entire year. There were some items that were in this case done what? Disposed of. On this item disposed, there was already what? An accumulated depreciation. So we end up having to eliminate that accumulated depreciation because we no longer have that item of plant. So it is here. It is here. So it means in this case, if it is here in our accumulated depreciation account, we likely end up having to do what? Debit. So in this case, it will be disposal. On disposal, how much was the accumulated depreciation on this item that was disposed? It was 96. It was 96. Ideally, what you're having to do here, you're having to eliminate this depreciation from our accumulated. Hello, 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 hello. I don't know what is happening with the mic. I don't know what is happening with the mic. It is having to go off. I don't know what is happening with the mic. I don't know what is happening with the mic. Let me see whether I can be able to change it. Just a minute. Hello, hello, hello. Confirm whether it is okay. So confirm whether it is okay. Confirm whether it is okay. Confirm whether it is okay. I can see Chris says okay. So we're having to say that in this case, for this particular account here, it is an account that will be able to tell us how much was the depreciation during the year. Because one of the items that in this case we have under operating activities, we normally adjust in this case what depreciation over the year, during the year. So it basically gives us what was the charge of depreciation for the entire year. So we'll get the opening balance, the closing balance. We remove off any depreciation on any item that was actually disposed of. Then in this case, the balance we'll actually be able to get, it is the depreciation for the year. So depreciation for the year, depreciation for the year. For the year, the balance we'll be able to get is the depreciation for the year. And of course, you can actually be able to add. So this one comes to 0. This one is 13. This one is 10. Is it 1030? So 1030 minus 625. What do you get? You get 405. I think you get 405. 1030 minus 625, you'll likely end up having to get 405. So this is the depreciation charge for the year. You get 405. So this one will basically be under what? Will likely be under the operating activities, non-cash items. So it will be under the non-cash items under what? Operating activities, under operating activities, under operating activities, under operating what activities. So that is in this case what is actually very important. You take note of that. So for this account, you've been able to know the acquisition of any additional item or plant. For this account, you've been able to know in this case whether there was a gain on disposal, which are still part of the items appearing in the cash flow statement. For this account, you've actually been able to know in this case whether there was what was the real charge of depreciation for the year. So it will be able to get it in what? In the accumulated depreciation account, whereby we eliminate that depreciation that was on that item that was actually disposed of. So once we eliminate it, then we know the actual depreciation for the year. So that's why it is actually very important. So we can actually go to the other working, which will be working number 3. So this one is actually in connection to note number 2. You are told in this case under note number 2, the 10% convertible loan stock was converted at any time at the holder's option. So if you look at, in this case, the statement of financial position, the 10% loan stock, at the start of the year is actually in this case how much? 960. 960. Then at the end of the year, it is how much? 780. 780. What is the difference? What is the difference? So at the start of the year, it is 960. At the end of the day, it's 780. You need to be able to look at, in this case, what? The statement of financial position you've actually been given. The difference is how much? I can see Ruth says 200. Debbie says 180. It is 180. Ruth, it is 180. 180. So it means part of the persons who had subscribed to this 10% convertible loan stocker, or this particular loan stocker that in this case the company had acquired, the persons who had given that loan, actually they exercised these rights, whereby maybe they told the company that amount you've actually lent you, that 960, we would like you to convert part of it to become what? Ordinary share capital. So that's why they're having to say here, holders of 180 million of the 10% convertible loan stock actually exercised their conversion option. They ideally converted the loan into what? Shares. They converted the loan into what? Into shares. And of course, in this case, if you look at the ordinary share capital, at the start of the year, just still on the statement of financial position, it is having to say what? At the start of the year, the ordinary share capital was 1 million. At the end of the day, it was how much? 1320. So ideally what it means in this case, there was more subscription of ordinary share capital by 320. By 320. But ideally, this 320, not that they actually received the cash. 180 of it, actually it was conversion of a loan into ordinary share capital. there was no real actual inflow they got on 180 of these 320. Actually, those persons who had lent money as a loan, they told them, actually convert this loan of 180, part of it, of the total amount, to become what in this case, ordinary share capital. So for the 180 convertible option, there was no real inflow of cash. It wasn't there. But of course, for the extra amount up to 320, it means probably the company would have actually been able to do what? Realize cash. And of course, in total, by the end of the year, the ordinary share capital was how much? 1320. So in any case, in this case, if we come up with the ordinary share capital account, so like that. So our shillings are actually in millions. Our shillings are actually in millions. So the balance brought down for the ordinary share capital, it is 1 million. The balance carried down for the ordinary share capital by the end of the year, it is 1320. 1320, 1320, 1320. This ordinary share capital during the year increased, whereby holders of 180 million loan stock actually ended up having to do what? Convert to what? To this, convert to ordinary share capital. So in this case, it means we'll likely end up having to credit here 10% loan stock. 10% loan stock of 180, they agreed they'll be part of the ordinary share capital. So it means the double entry will likely basically having to do what? Debit the loan stock account, which in this case end up having to reduce it from the start of the year 960 to 780. 780, 780. So this item was having to do what? Affect the ordinary share capital. And therefore, in this case, if you look at the total here, this one is actually how much? Exactly in this case, 1320. This one is actually 1320. So it means the total here is 1320. So we have in this case a balancing figure here of how much? We have a balancing figure here of how much? We have a balancing figure there of how much? 140. 140. 140. So this means this 140 is the extra cash they got in ordinary share capital. Is the extra cash they got in terms of what? The ordinary share capital. That balancing figure. That balance. So that in this case, by the end of the year, they had what? 1320. So in this case, this one is actually cash they received. This one is cash. Only that I don't have space here. You need to put in bracket and say cash received on sale of shares. This is cash received on sale of shares. So it ended up having to increase the ordinary share capital. It means what is happening here, we are debiting the cash account because they got extra 140. So for the 180, which was part of the 320, which increased from here to here, it was not real cash they received. It was just a loan they converted. So that can't be real inflow of cash. So we'll end up having to credit here so that we can be able to know the balancing figure, which will likely end up having to be part of what in this case, the ordinary share capital that was actually received in terms of cash. So that is what you'll be able to get there. So that's how basically in this case, you likely end up having to deal with that. 180 million, 10% convertible loan stock, convertible loan stock, convertible loan stock, convertible loan stock. So if you look at just still the same case, under equity items, there is that share premium. There is that share premium that was actually received. So if you see the share premium in this case, it is 400 at the start of the year and 460 at the end of the year. So let's assume in this case, just still the same working. Maybe you can be able to say, working for. So share premium account. So with the share premium in this case, shillings in millions. So the balance brought down for the share premium, you can be able to see it is 400. It is actually 400. Then the balance carried down, it is 460. So 460, then 460. 460, so you have in this case cash of 60. It's the same concept as this one. So just the same concept as that one. Just the same concept as that. And of course, when you talk about share premium, it is an extra amount they would have ended up having to get whenever in this case they did what? They sold shares. Probably it was this stock that they actually sold, but they sold it at an amount over and above the par value. So they ended up having to get extra 60 shillings, extra 60 shillings. So overall on the sale of these shares, they actually got 140 plus 60. 140 plus 60. So automatically in this case, when we're talking about financing activities, these two figures have to appear, 140 and 60. So because in this case, any cash received on sale of shares, it is having to come under what? I think it is financing activities. Yes, financing activities. It is coming under 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 financing activities. So we'll have to remember. We'll have to remember. So I repeat the ordinary share capital account. I repeat the ordinary. Anthony, have you understood? So, so this is the balance brought down. If you look at the balance sheet, this is the balance brought down. This is the balance carried down at the end of the year. If you look at note number 2, 180 million loan stock was converted to ordinary share capital. So that one, they didn't receive real inflow of cash. So you basically need to consider it and credit because it was having to increase still what? The share capital. Then you get the difference. So this is the balance. This balancing figure is the cash they received when they sold shares. Is the cash they received when they sold shares. That 140 is the cash they received when they sold shares. So that is what is happening there. That is what is happening there. Then under note number 3, you've been told impairment loss on goodwill. Impairment loss on goodwill and depreciation for the year ended 30th of September 2018 have been charged to the profit and loss account. So of course, you've actually already been able to deal with what? Depreciation here. You dealt it with there. But now we have in this case what? Impairment. Impairment happens on what? It happens on goodwill. It happens on goodwill. So in this case, when you're talking about consolidated financial statements, we are talking about matters what? Goodwill. We are talking about what? Matters goodwill. Matters goodwill. Matters goodwill. And then in this case, you can actually be able to look at the goodwill. Goodwill. You can see goodwill there. Goodwill at the start of the year is how much? Goodwill at the start of the year is how much? Goodwill at the start of the year is how much? It is 455. And at the end of the year, 432. So it means it had lost value by how much? It had lost value by how much? It had lost value by 23. So that is the impairment. That is the impairment. That is the impairment. That is the impairment. That is the impairment on goodwill. That is the impairment on goodwill. So maybe you can be able to, in this case, just clarify there. We can actually be able to clarify there. So maybe working 5. You have in this case goodwill. Goodwill. So with the goodwill in this case, it is of course an asset. Exactly, of course, an asset. So assets will have in this case a debit balance. They'll have a debit balance. So they'll have a debit balance. Assets will have a debit balance at the start of the year. So balance brought down is exactly 455. Then balance carried down at the end of the year, it is 433. It means impairments is actually 20. You said 20, 432, sorry, 432. It means impairment is 23, which in this case ends up having to balance as 455. This one is 455. So this one is impairment. And of course, it will likely appear under operating activities together with this figure, which is loss of value on what? Actual assets or physical assets. This is impairment. They'll appear there. So the loss in value in terms of the goodwill was actually in this case, how much? 23. Was actually 23. So it was actually in this case 23. It was actually in this case 23. It was actually in this case 23. So so the other item in this case you have to look at, it is of course what? The non-controlling interest. If you look at the non-controlling interest, so non-controlling interest or NCI. So the NCI at the start of the day is actually 180. Then of course at the end of the day is actually 186. 186. Then if you look at the income statement, the profits attributable to non-controlling interest is actually in this case 25. Exactly in this case, how much? 25. Then, of course, in this case, there was also a revaluation. There was actually in this case a revaluation on the assets of in this case what? On the assets of in this case what? The subsidiary by 150 million. By 150 million. So it means in this case the net assets actually went up by 150 million. So we can in this case prepare the NCI account. Let's just prepare the NCI account so that you can be able to see what we'll be able to see. You can be able to see. Can be able to see the dividends that was actually paid. The dividends that was actually in this case paid to the NCI or the non-controlling interest. So that will end up having to be what? 6. You have in this case the non-controlling interest. So if you look at the non-controlling interest in the statement of financial position, it has a balance brought down. It has a balance brought down. It is an equity item, so it will have a credit balance. It's an equity item, it will have a credit balance. So it has an opening balance of 180. Then the balance carried down at the end of the year. The balance carried down at the end of the year from the statement of financial position, is in this case how much? Is actually 186. 186 is actually an amount of 186. Then the profits that were in this case attributable to the NCI or non-controlling interest from the income statement, which in this case you can be able, it is the last figure in the income statement. So profits attributable to the non-controlling interest. Profits attributable to the non-controlling interest. So while you are debiting the income statement, here we'll end up having to credit. So in this case, you have the income statement. Income statement, we are told in this case, the profits attributable to this NCI, it was an amount of 25. It was an amount of 25, an amount of 25. Then still on the net assets, of the subsidiary, that is under note number 1. During the year ended 30th of September, an 80% owned subsidiary revalued its property upwards by 150 million. So they revalued in this case what their assets by 150 million. So it means in this case, the value of in this case the NCI also in this case ended up having to do what? To increase. It ended up having to increase because they revalued their assets. They revalued their assets. So there was in this case what? A revaluation that was having to affect what? The non-controlling interest. Remember the non-controlling interest in this case, because it was an 80% owned subsidiary, then the non-controlling interest in this subsidiary was actually how much? 20%. So if they happen to have revalued the assets up, the value of this NCI will also end up having to go up, which is what? An equity item. It will actually go up. And if it is having to go up, it means we're having to credit. So then in this case, you have that revaluation on that 80% subsidiary. So that is under note number 1. That revaluation under note number 1, which in this case we are told is of an amount of 150 million on an asset. But remember the NCI are controlling 20%, not 80%. They are controlling what? 20%. So in this case, it will likely be 20% multiplied by the 150 million. So that is the revaluation that is actually there. The revaluation that is actually there. And then in this case, we'll likely end up having to get 30. It is 30 million. It is 30 million, I think. It is 30 million. So 30 million. So 30 million. So if you add the figures, this is 205 plus 30, you get 235. 235, you get in this case 235 like that. 235 like that. So with this, we'll be able to get a balancing figure. So there'll be a balancing figure here. There's a balancing figure here of how much? So 235 minus 186. 235 minus 186. 235 minus 186. 235 minus 186. you get 49. So you'll likely be able to get a balancing figure of 49. This balancing figure, it is the dividends paid, to the non-controlling interest. Is the dividends paid that will likely settled or paid to, in this case, what? The non-controlling interests. Is the dividends that was likely paid in this case to what? To the non-controlling interest. So of course, now in this case, we're having to say during the year, they were given part of the profits, 25. Their opening balance was 180. By the end of the year, it was 186. During the year, there was a revaluation of part of the assets of a 20% owned subsidiary. In this case, we need to revalue the NCI up by 20%, considering that revaluation of the assets, which is 30. It means, in any case, they had paid dividends to the NCI, it will likely be an amount of how much? 49. An amount of 49. And of course, this one will likely end up having to appear, and I think the financing activities of the subsidiary, financing activities of what? Of the group cash flow statement. So under the financing activities. Then we can now, in this case, look at tax issues. Tax account, we can look at the tax account, tax expense account. Tax expense account. So the tax expense account, from this account, you'll be able to know how much was the tax that was actually paid during the year. And of course, this one will have two opening balances and two closing balances, because there are two elements of tax. There are two elements of tax. We have, in this case, the deferred tax, and of course, you have the current tax. We have the deferred tax, and of course, what? The current tax. We have the deferred tax, and of course, the current tax. So these particular liabilities, so it's, in fact, it's supposed to be tax liability. Okay, tax liability account, the tax liability account. Tax liability account, tax liability account. Tax expense liability account. So these ones, you can also be able to get the opening balances and closing balances from the statement of financial position. So in this case, there are two elements here regarding the balance brought down. So balance brought down. We have, in this case, the current tax. And of course, you have, in this case, the deferred tax. Deferred tax. So if you look at the statement of financial position, the current tax is, of course, under the current liabilities. And of course, you can be able to see an opening balance of 94. And for the deferred tax, you can be able to see an opening balance of 185. So if you look at the balances at the end of the year, still, you'll end up having to look at what was happening during the end of the year. So that is balance carried down. So there are two elements still, current tax, and of course, you have, in this case, what? Deferred tax. We have deferred tax. So for the current tax, you can be able to see there's an amount of 92. And of course, in this case, for the deferred tax, there's actually an amount of 150. 150. So those are the balances at the end of the year. These are the balances at the start of the year. But now, if you look at the income statement, this is what, in this case, they had charged during the year as what? As the tax expense, So if you look at the income statement, there's a tax liability. There's an income tax expense of 180. So in this case, in the income statement, there's a tax expense or income statement. In the income statement, there's a tax of 80. So you end up having to credit it here, because it was having to increase what? The tax liability during the year. You credit it here. It is actually an amount of, in this case, how much? 80. It is an amount of, in this case, what? 80. It is an amount of, in this case, what? 80. It is an amount of, in this case, what? 80. It is an amount of, in this case, what? 80. It is an amount of, in this case, what? 80. An amount of 80. An amount of 80. But of course, there's another item still having to affect this what? Tax liability. It is having to touch on what? The deferred tax. It is having to touch on the deferred tax. It is having to touch on the deferred tax. So remember, when you are talking about deferred tax issues, we said in this case, you compute what we call what? Is it temporary difference, or TD? So you compute in this case what we call what? Temporary differences. So temporary difference, well, in this case, you need to get the carrying amount, then you less what? The tax days. You less the tax days. You less the tax days. And of course, in this case, the carrying amounts are actually in regard to what? Assets. The carrying amounts are in regard to what? The assets of the company, assets of the company, assets of the company, assets of the company. And of course, you can be able to see there were, of course, assets of the subsidiary, but part of them were revalued up. It means the carrying amounts of these assets overall in the entire group, they increased. And of course, in this case, the temporary differences will end up having to go up if this one ended up having to go up. And how do we normally, in this case, compute deferred tax? We say in this case, you take the tax rate, then you multiply by what? By the TD. So if it happens that the carrying amounts of some of the assets were revalued up, it means the TD is going up, and overall, the deferred tax is having to go up. We said in this case, when you are getting deferred tax, you need to compute the temporary differences. How do you get the temporary differences? You get the carrying amount, you less the tax base. What is this carrying amount? Is what the assets are having to be reported at in the books of accounts or the financial statements. Their carrying amount. Their carrying amount. So part of the assets in this group have actually been affected. The carrying amount has actually ended up having to go up because there was a revaluation, which brings upon what we call what? Revaluation gain. Revaluation gain, which in this case will end up having to increase what? The TD. If the TD is having to go up, automatically the deferred tax is having to go up. And therefore, in this case, we likely end up having to get the deferred tax increase on revaluation. Deferred tax increase on revaluation. The deferred tax increase on revaluation. The revaluation in this case was of an amount of 150 million. It was of an amount of 150 million, 150 million, 150 million. There was a revaluation in this case of an amount of 150 million. So therefore, in this case, we'll likely be able to get, it will be 150 million. So 150 million, that was in this case the revaluation. Then the control in this case was how much? 80%, was actually in this case 80%. Then you multiply by 30%. So you'll likely be able to get the deferred tax there. So it is 150 multiplied by 80%, multiplied by 30%. You'll likely multiply in this case by 30%. You'll likely multiply by 30%. So it will likely be 150 multiplied by 80% multiplied by 30%. I think you'll get a figure of 36. Is it 36? You'll likely end up having to get a figure of 36. I think it will be 36. 36. It will likely be 36. So 36, I don't know whether you're able to see there. You're not able to see there. So 36. So when you need to add, so because in this case, when you eventually add, then in this case, you'll be able to get the balancing figure. There'll be a balancing figure here. There'll be a balancing figure here, which now in this case will be the tax paid during the year. Tax paid during the year. So what is the total? When you add, what is the total? What is the total? It is 395. 395. 395. So 395 minus this 80% is the percentage of control. It is actually 80%. So it's actually the percentage of control. The percentage of control in this case, what? In that subsidiary that was having to be revalued. It is the percentage of what? Of control. It is the percentage of control. Percentage of control. It is in this case how much? The difference. So 395 minus 150 minus 92. You get 153. Is it 153? Yes, it is one. It should be 153. 153. So this is the tax paid. So there's somewhere in this case under the operating activities, we end up having to report what the tax paid. So the tax paid during the year in this case was an amount of 153. So this is basically cash. This was cash. It was actually cash. It was in this case how much? Cash. It was actually cash. It was cash of 153. 153. 153. So we can do the last one. We can, in this case, do the last one, very, very fine one. So that is the interest expense account. Interest expense account, because there's what? Finance cost. There's somewhere in this case, we talk about finance cost. Finance costs. So finance costs, we adjust it also under operating activities. So we have in this case the finance cost or interest payable, the interest payable account. So this interest payable, you can be able to see it as part of the current liabilities. The interest payable, you can be able to see it as part of the current liabilities. We have an opening balance of 94 and a closing balance of 92. So the balance carried down here, so the balance carried down, because it is shillings millions, So the balance carried down here, it is an amount of so the interest payable. The interest payable is an amount of 31. So the opening balance is actually 31. Then the closing balance is actually 100. Yes, the opening balance is actually 31. The balance brought down is 31. Then the balance carried down is 100. Is 100. But of course, when you talk about interest, it's all about, in this case, what? Finance activities. So if you look at the income statement, there was the finance expense they incurred during the year, which in this case is an amount of 85. So in the income statement, so finance costs in the income statement, finance costs in the income statement. So you can be able to see there was a finance cost of 85. Is it 85? Finance cost was actually in this case an amount of 85. It was an amount of 85. So if you get the total here, so this one actually comes to 116. So 116. So in this case, it means the balancing figure there will likely be the interest paid. So balancing figure is the interest paid during the year. Interest paid during the year, which is an amount of 16. An amount of 16. So this is basically, this item will likely appear together with this one under the operating activities. Under the operating activities, as the interest paid and of course the tax paid during the year, as the interest paid and of course the tax paid during the year. So those are part of the adjustments you need to be able to make. So after that, now in this case, I think we can now in this case now prepare the cash flow statement. We can now prepare the cash flow statement. We can prepare the cash flow statement. We can prepare the cash flow statement. So why does the interest payable have a credit balance? So it is a liability. So are you able to see it? So you can see it is under current liabilities. All liabilities will have a credit balance, credit opening balance. It is a liability. What about retained earnings? What about retained earnings? What about retained earnings account? Retained earnings account. What about the retained earnings account? So I don't think we'll be able to make any adjustments regarding the retained earnings account, because overall, even when you look at in this case, what our when you look at in this case, overall, in this case, our cash flow statement. So there's no way in this case we actually end up having to talk about retained earnings. Retained earnings, because ideally, any items that would have actually been able to affect the retained earnings, we have already been able to make adjustments on them. It could be depreciation, it could be gain on disposal, it could be loss on disposal, it could be finance costs, it could be the income tax, the tax expense. You already made adjustments on them. So the only item that in this case, for example, will likely end up now having to appear as part of the group cash flow statement, which of course now in this case you can be able to see it under the adjustments for non-cash items. The there's somewhere in this case, we've actually been able to indicate maybe investment income or dividends income. Maybe in this case, this one could actually be maybe from a joint venture or maybe from an associate, or maybe there can be what we call what an associate profit. An associate profit is part of the items only having to appear there that is related to what retained earnings. But overall, the retained earnings, we've already been able to deal with it because this one, the interest expense, we've dealt with it. In this case, for example, the tax expense, we've dealt with it. Depreciation, we've actually dealt with it. Gain on disposal, we've dealt with it. So overall, in this case, we've actually been able to tackle any item that would have actually affected the retained earnings. That would have actually affected the retained earnings. So we want to make any other adjustments regarding what the retained earnings. But now in this case, we can now actually end up having to proceed and prepare now in this case our cash flow statement. We can now prepare our cash flow statements. We now in this case will likely end up having to prepare our cash flow statement. So you can see you are saying in this case it will likely help us in having to determine the dividends. So the dividends, dividends in this case that was actually paid by dividends paid by associate, or maybe in this case paid by the subsidiary. Was it dividends paid by the associate, or maybe in this case paid by the subsidiary? But of course, for dividend paid to NCI, so the dividend paid to NCI, we've actually already been able to calculate it here. Is here an amount of 49? So dividends maybe in this case to ordinary shareholders. I think we have revaluation gain of 105. We have in this case what? Total comprehensive income. We have in this case ordinary share capital share premium revaluation surplus, retained profits of 360. Then at the end of the day is actually 570. Then in this case we have dividend paid by the parent entity, dividend paid by non-controlling interest, which you've already been able to compute, So if you look at now, there's the statement of changes in equity. So just look at the statement of changes in equity. There's an item of dividend paid of 80. I don't know whether you can be able to see there. So under the retained profit, there's an item of, in this case, how much? 80. And of course, it's the difference between the opening balance of 360 and of course the profit for the year, which is actually in this case 290, and of course the balance at the end of the year. So of course in this case for the dividend paid, you've actually already been given there. So I can see what Ruth is having to mean. It means in this case, if we had not actually been given that figure, then probably in this case we would have been able to use the retained earnings to be able to get what the dividend paid. So it is okay. It is okay because that particular figure we've already been given there. But of course, you're not having to go to do any kind of computation because it's already there in the statement of changes in equity. So that item of 80 is one in this case that will end up having to say dividend paid under what? Financing activities. Which is an amount of 80. So we can now in this case prepare the statement of cash flow. By in this case listing the operating activities, listing the investing activities, and of course now in this case we also list what? The financing activities. So we'll start in this case with the profits before tax. So we have in this case the company is known as Sasuma Group. Sasuma Group consolidated statement of cash flows. It is for the year ended, supposed to be for the year ended. For the year ended 30th of September 2018, because you have shillings in millions, So we can start with operating activities. We start in this case with the profit before tax. Profit before tax is how much? Profit before tax is how much? What can you be able to see as the profit before tax? Profit before tax is how much? What is the profit before tax you're having to see? Profit before tax is 395, exactly 395. 395. So this one you can be able to get it from the income statement. It is there. So before they charge tax, there's that figure you're having to see, 395. Then you can, in this case, adjust the non-cash items. So adjustments. So for the non-cash items, you can be able to adjust. So of course you have in this case depreciation. Depreciation is how much? Depreciation in ngapi. You have impairment of goodwill. Impairment of goodwill. So depreciation is how much? Is 405. So 405. Impairment is how much? So this one you add back because it was not real outflow of cash. So you add it back. 405. What about impairment? Impairment is how much? Impairment is exactly 23. So these ones you add them back because they were not real outflow of cash. When you depreciate, you're just depreciating, but kuna pesa unalipia your depreciation. Una depreciate too. It was reducing your profits. Before you got this figure, it was reducing your profits. You add it back, So this one, you can check your workings. I think this one we did it under working 2. This one, I think we did it under working 5. You can be able to check your workings. Then you have in this case finance costs. Finance cost in this case, you'll be able to take the one that is actually in this case in the income statement, which in this case is an amount of, you'll add back that finance cost of 85. That finance cost of 85. Then you have in this case gain on disposal. This one you deduct because it was not real inflow of cash. It was not real inflow of cash. And of course, if you look at our working number 2 under the disposal account, there's a figure you've actually been able to get of 21. So that gain on disposal, you deduct it. Then there is, I think, working number 6, we did what? Working number 6. So there's working number 6. There's one working that in this case we haven't done, but now in this case you can just be able to. So if you look at in this case, I think the format of the cash flow statement. So we have an item of share of joint venture profits. So share of joint venture profits. Share of joint venture profits. Share of joint venture profits. Share of joint venture profits, which in this case is an amount of 85. An amount of 85. So for this joint venture profit, if you look at the non-current assets, so there's in this case the non-current asset there, you can be able to see there's interest in the joint venture. There's actually interest in the joint venture, which in this case we have an opening balance of 380. So there's actually interest in the joint venture. Maybe you can just be, I don't know whether we had done this. Interest in the joint venture. Interest in the joint venture account. So if you look at the non-current assets, there's a balance brought down of this joint venture investment, balance brought down of this joint venture investment. It is an amount of 380. It is an amount of 380. Then there's the balance carried down at the end of the year. It is an amount of, in this case, 427. 427. 427. 427. Then if you look at the income statement, if you look at the income statement, there is a share of profit from the joint venture. Share of profit from the joint venture. So it was for the joint ventures and of course for the associates, we likely end up having to account for them under what the equity method. And therefore, during the year in the group accounts, they were able to report part of the joint venture profit was shared to the group. And in this case, they received an amount of what in this case? 85, an amount of 85. So this amount of 85 in the income statement, of course, now in this case, that was a gain. It was an income, and therefore they were having to do what? Credit. But now in this case here, we likely end up having to do what? Debit. So in the income statement, we have from the interest in the joint venture, income statement, we have interest from the joint venture, in the profit from the joint venture. It was an amount of, in this case, how much? 85, an amount of 85. So in this account, what we likely end up having to be computing, it is the dividends in this case, what? Received. It is the dividends received from the joint venture. So the dividend received from the joint venture, dividends received from the joint venture, dividends received from the joint venture. So of course here it is 465. So 465. So you need to get the difference. So 465 minus 427. So with that, you'll be able to get the dividends received from the joint venture. And of course, this part of the items you'll be able to make as adjustments here. So there's dividends received from associate, and of course, dividends also received from what? From a joint venture. Joint venture, in this case, it simply means they have been able to share 50-50. We have in this case 50-50. So they got some profits. They got some profits in this case from what? From this joint venture. They got some dividends from this what? Joint venture, whereby they had invested 50 in that what? Joint venture. 50 and itself the minority, or they don't have the minority actually. They are 50-50. So they are 50-50. So in this case, the share of the joint venture profits in terms of, for example, dividends, it is the difference between the two, which in this case comes to an amount of how much? 38. 38. And of course, in this case, I hope under the format that I actually gave you for the cash flow statement, there's somewhere indicated that share of joint ventures, what? Profits, something like that. So must have actually been able to indicate. It will likely end up having to come under what? These adjustments. It will come up under these adjustments. And therefore, in this case, share of the joint venture profits, which is under that particular working, So it is an amount of, in this case, how much? 38. It is an amount of, in this case, 38. An amount of 38. An amount of 38. An amount of 38. So in this case, you're having to get an amount of 38. An amount of 38. So this is the dividend received from the joint venture. So dividend received from what? From the joint venture. So actually what will happen? So this one will likely come under, in this case, what? The investing activities. It will come under the investing activities. So what we'll be able to recognize here is the share of the joint ventures, what? Profits. Which now in this case, it is from the income statement, which is an amount of 85. So here we'll likely be able to recognize, in this case, 85. But now this one will now appear now in this case under what? The investing activities. So when you come under investing activities, there is an item of dividend received from what? From the joint venture, which will be able to pick that 38. But now the share of the joint venture's profits, which in this case is the income statement, will likely end up having to adjust it here by 85. In any case, there was also in this case share of profit from an associate would have also been able to eliminate it here. So the share of joint venture profits or share of associate profits will eliminate it here. So that's what will likely end up having to happen. Then we can be able to look at the working capital items. Working capital items. working capital items changes. Working capital items changes. So for the working capital items changes, we have in this case inventory. Inventory was having to increase. There was an increase. And of course, you look at the difference at the start of the year and of course at the end of the year. So it is 128, in this case, an amount of 170. So the difference there is actually an amount of 42. And of course, if they're having to increase, you deduct. Then in this case, you have receivables. They were also increasing. Receivables, it was an increase. So it was in this case from an amount of 214 to 238. These are at the start of the year. These are the start of the year. These are the end of the year. These are the end of the year. So the difference there is actually an amount of 24. 24, you deduct. You deduct. So any increase in the current assets, you end up having to do what? Deduct. Then in this case, if you look at the current liabilities, we have in this case the payables. The payables still in this case, they were having to do what? Increase. They were increasing. So they're actually increasing from an amount of, in this case, 175. In this case, an amount of 234. So for the increase, for the current liabilities in this case, you likely end up having to add. So it was in this case, 59. It was actually in this case, 59. So you'll be able to get here the figure for the gross operating cash flows. Figure for the gross operating cash flows. So whereby you'll have to add all these. You'll have to add all those. So we need to keep this working. So we'll pick this figure. We'll pick this figure of 38. We'll pick this figure of 38. But now you need to get the total here for the gross operating cash flows. The figure for the gross operating cash flows. The figure for the gross operating cash flows. The figure for the gross operating cash flows. Then now we can deal with the tax. And of course, now in this case, what? Interest paid. So from this figure, you less number one, tax paid. Tax paid, and of course, in this case, also what? Interest paid. So these ones we've actually been able to do computations in our workings. So this one is in the tax expense account. This one is in the interest payable account, interest payable account. So this one, I think it is under working 8. This one is working 9. So this one is 153 million. This one is 16 million. So 16 million like that. 16 million like that. What are you having to get here as the gross operating cash flow so that you can be able to deduct? We get in this case the figure for the net operating cash flows. The figure for the net operating cash flows. The figure for the net operating cash flows. So this one is how much? This one, if you add 395 plus 45 plus 23 plus 85 minus this, minus this, minus this, minus this, plus this. You get a figure of how much? The gross operating cash flows. $795. So you should be able to get 795. 795. So 795, you less the tax paid and the interest paid. This one you've done it under working 8. This one is under working 9. Look at that account. There are figures you are getting as balancing figures, which we're having to say that is now the expense, the cash they paid during the year. That is the cash they paid during the year. That is the cash they actually paid during the year. That is actually the cash they paid during the year. So you get how much? When you do 626, so 626. And of course, this is the first part whereby we've actually been able to get what? The net operating cash flows, net operating cash flows. So we can now, in this case, go to cash flows from investing activities. So we have, in this case, investing activity. So with investing activities, they did some disposal, and of course, they did some acquisitions of assets. So we have, in this case, disposal proceeds. Disposal proceeds. This one doesn't need a working. You've already been given an additional information, number 1. So of course, when you dispose, you are paid cash. So that is an inflow of money. So it is increasing your inflow in terms of cash. When you sell an asset, they pay the money. They pay you the money. So they paid, in this case, as per note number 1, 215. But as per property, plant, and equipment account under working number 1, there were some extra acquisitions done during the year. So therefore, in this case, we have acquisitions of PPE, acquisitions of property, plant, and equipment, which we had a balancing figure of, in this case, an amount of 935. 935. Then from investing activities, they ended up having to get some dividends from the joint venture, which we've just done the working here. So dividends from a joint venture, dividends paid from a joint venture, dividends from a joint venture, dividends from a joint venture. So in this case, we were having to get a figure of 38. I don't know it was you're working what? Would it be working 10? Maybe you can be able to give it a number. Maybe you can call it working 10. You can call it working 10. You can be able to give it a number. You can call it working 10, assuming the others were going to working 9. You can call it working 10. Then in this case, we're having to see the dividends that was actually received from the joint venture was actually, in this case, an amount of 38, an amount of 38. So that's when you add, it is an inflow, sorry. You add, it is an inflow because they paid. Is an inflow, they paid to the group 38. So it is an inflow of money. It was actually paid. It was actually paid. So you add 38. And I think those are the only items that you'll have there. So you need to add them so that in this case, you can be able to get the net investing cash flows. So net investing cash flows, the net investing cash flows. What did you get? 215 minus 935 plus 38. Negative 682. Negative 682. Negative 682. You can confirm that figure from current call. Negative 682. Negative 682. So it is negative 682. So that becomes our second part. So this is the first part. This is the second part. So from investing activities, those were the cash flows. They were negative. Then in this case, you can go to the very, very final part. That is what? Financing activity cash flows. Financing activity cash flows. Financing activities. So financing activities cash flows. Financing activities cash flows. So under financing activities cash flows, then we have some shares which were actually issued. So issue of shares, we have in this case issue of shares. What was the figure that we received from issue of shares? What was the figure that was received from issue of shares? Faith, the figure that was actually received from issue of shares, it was 140. So 140. From share premium, it was how much? From share premium, it was how much? 60. It was actually in this case 60. It was actually in this case 60, like that. It was actually in this case 60, like that. So we can just continue. So you've already dealt with the issue of shares and of course the share premium. Issue of shares and of course what? The share premium. Issue of shares and of course the share premium. Then we have in this case some dividends, which was in this case actually paid, to dividend paid. Dividends that was actually in this case paid out, And of course, if you look at the statement of changes in equity, so we have in this case dividend paid there, which we've actually been told there. We have in this case 360. So under the retained earnings, we have 360. We have in this case 570. Then you have in this case profit for the year, which is actually 290 to the 80% to the parent company, which is 290, sorry. Then it means in this case, the dividends that was actually paid is actually 80. So already in this case, we've actually been able to compute that under what? The statement of changes in equity. So you have in this case, dividend paid by the parent company. Dividend paid by the parent company. We've already been given in the statement of changes in equity. So because it is an amount of what? 80. It's an amount of 80. So they were paying. Then in this case, you have dividends paid by the non-controlling interest. This one you've been able to do it under working 7, under the NCI account. So we got in this case a figure of 49. Was it 49? I think it was 49. It was actually in this case a figure of 49. It was a figure of 49 like that. So I think those are the only items that you'll be able to have under financing activities. Those are the only figure you'll likely end up having to have under the financing activities. The only figures you'll end up having to have under the financing activities. Those are the only figures you'll be able to have under financing activities. So you can be able to add, you can actually be able to add. So what are you having to get as the net cash flows from financing activities? So net financing cash flows. So net financing cash flows. The net financing cash flows. The net financing cash flows, what do you get? So 140 plus 60 minus 80 minus 49, you get 71. So you get in this case 71. So this will be part C. Part C. So therefore, in this case, the cash and cash equivalents, the cash and cash equivalents for the year, it means we'll be able to take A plus B plus C. What do you get when you take A plus B plus C? What do you get when you take A plus B plus C? A plus B plus C. A plus B plus C. So we need to add A plus B plus C. Faith says 1379. I don't know where Faith is having to get that figure. You take A plus B plus C. This is our A. This is our B. This is our C. So Faith, how are you getting 1379? Debbie, how are you getting 1379? When you take A plus B plus C, remember this one is negative. Remember it is negative. It is 15, it's supposed to be 15. This one is negative. So don't add 626 plus 682. That one is negative. So you take 626 minus 682 plus 71. So it should be able to give you 15. Then in this case, you add the cash balance at the start of the year. Add the cash balance brought down at the start. It is how much? The cash balance brought down at the start of the year. The cash balance brought down at the start of the year is how much? Casti says 63. It is actually 63. Yes, it is 63. When you add, it should be able to give you the cash balance at the end of the year. Cash balance carried down at the end of the year. It should be able to give you the cash balance carried down at the end of the year. Still, you should be able to get it from the statement of financial, which in this case should be 78. So we said in this case, if it doesn't tally, then it means there's a problem with maybe the adjustments here. So you need to maybe in this case to look at what you could have actually made as what? As an error. You can be able to look at what you could have actually been able to make as what? As an error. Make as an error. So of so much importance here, you need to be in this case keen with those figures that in this case will need like key adjustments. That you need like in this case key adjustments. So for example, in this case, if you want to get the acquisition on PPE, it means you'll come up with the property, plant and equipment account. Another key figure that in this case you might end up having to compute, especially here. This one, if it's a group cash flow statement, you'll actually end up having to compute. So just remember in this case how we've been able to come up with what? The tax expense account. Also, this one you'll likely end up having to compute. But the disposal proceeds, this one is very direct. Also, these items of changes in working capital items is all about, in this case, having to compare what is the opening balance under the closing balance, you get the changes. You get the changes. So those ones, they don't need, for example, in this case, complicated what? Adjustments. So those ones you can easily be able to score marks on them. This one you can easily score mark on it because it will just be in the additional information. When they sold an item of plant, this is what they ended up having to do what to receive. The changes in the working capital items will be there. So this figure about the profit before tax, you'll automatically, in this case, get it in the income statement. Unless in this case, they haven't provided what? An income statement. Maybe they'll be able to say in the additional information, they can be able to give you the profit after tax. Profit after tax. It means you have to turn it into a profit before tax by adding tax on it. Tax for the year on it. So that in this case, you can get the profit that was actually there before what? Before tax. The profit that was actually there in this case, what? Before tax. Before tax. So those are part of what the key adjustments. Then in this case also, what you need to be very keen on, that will need that there's that NCI we've been able to compute. NCI, where in this case, in the NCI account, you'll be able to get the dividends that was actually in this case paid to what? To the non-controlling interest, to the non-controlling interest. Then which other key working in this case? So the others which are not actually very complicated. So for example, impairment on goodwill, it might end up not having to have so many, in this case, what? Adjustments. Gain on disposal of assets. If you prepare the disposal account, you'll be able to get the gain on disposal or loss on disposal, which you'll have to adjust under what? The non-cash items, under the non-cash items. So such kind of adjustments, in this case, you have to be very keen about them. You have to be very keen about them, So ideally, that is why in this case, you come up with what? A group cash flow statement. A group cash flow statement. A group cash flow statement. So I can be able to see Omondi says, he didn't see how in this case we got 49. So I think 49 in this case is in our NCI account. It is in our NCI account. So we took, in this case, we prepared the NCI account, whereby we credited the opening balance, we debited the closing balance, we looked at the income statement, what were the profits attributable to NCI, which was in this case 25, which we credited. Then there was a revaluation of 150 million. We also credited in that account, but we took 20% of that revaluation of the assets. We got that. Then, of course, the balancing figure was actually, in this case, how much? 49. So that is how, in this case, we ended up having to get at the dividend paid to the NCI, dividend paid to the non-controlling interest. Dividend paid to the non-controlling non-controlling interest. So I think that's it. I can be able to see, I just hear the word NCI. I just hear the word NCI, non-controlling interest. You don't have to fear it. So you have to, in this case, have the confidence that in this case, you can actually be able to conquer it. You can actually be able to conquer it. So I want us to move to the other area. So because there are like two major areas which are remaining in the syllabus, then I can do a theory session. There are two major areas remaining in the syllabus, which then the others, they are theory areas, which I think I'll be able to take you through. I'd already started taking you through the lunch hours, but of late I've been held up during the day. I'm so much held up a bit, so I haven't been able to do. I haven't actually been able to do that. So there are two key areas that are actually having to remain. There's, in this case, public sector accounting. Public sector accounting. Then, of course, there's, in this case, branch accounts. Branch accounts. The other remaining areas, so they are more of, in this case, the theory areas, which, of course, those ones don't have a major problem. So I just be able to take you through slowly by slowly, like in just one session. We'll be able to go through all of them. But we'll majorly, in this case, use the past paper questions to go through them. Like you look at the videos I've done, I think like 2 of them under the revision videos. We've done, I think, 2 past papers. We've done, I think, December 2024. Then we've done also August 2024. So if we stretch up to around 2023, we would have already been able to cover all those areas. And of course, there are those notes that are actually compiled for the theory areas, which I've also already been able to share. share with you. So there are these two key areas in terms of competitions which are still remaining, which in this case you have to look at them. You have to look at them. So we might end up having to cover them. For example, public sector, we'll do it tomorrow. We'll do it tomorrow. This one is not complicated. Not complicated. This one is just put to sour. Then this one, we have also branch accounts. Branch accounts. Branch accounts, they rarely test it, but it's in the syllabus. But they rarely test it. I don't know why they don't test. They don't actually test it, but you never know. You never know. KASNEB might end up having to surprise us. So they rarely test these one branch accounts, but it's in the syllabus, so we'll likely be able to cover it. So we'll wind up with public sector tomorrow. We might wind up tomorrow, but let's see what happens. But it's not, this one is not a complicated topic. Is that's okay. That's okay. This one, they rarely test it, but it is an interesting one. It's an interesting one. Like in this case, what published financial statements is an interesting one. Like in this case, what published financial statements. So it is just average, but they rarely test it. But we'll be able to see how companies that have branches can actually end up having to prepare their financial statements. Of so much importance, I can advise you at this particular point in time, whether you like it or not, understand these topics: published financial statements, understand group accounts, understand group accounts. Try your level best. Understand group accounts, understand group accounts. So this one, there's no magic. You have to, in this case, like repetitively go through the videos, and then of course also try to do questions by yourself. Try to do questions by yourself. So other than the ones you've been able to do in class, try to do questions by your, just choose a question randomly from the past paper and try to tackle it. Even if you tackle it wrongly, in the process, you get now in this case to go back. We said NCI, this is how it is dealt with. So you grasp it like that. You grasp it like that. We said in this case, goodwill, this is how you complete it using the full goodwill method. You try to go back, you try it by yourself. You try it by yourself. Because ideally, we are still going to do blocks. We'll be able to cover group, some extra group questions, and of course, published financial statement questions. But practice makes perfect. Practice makes perfect. Practice makes perfect. And of course, in this case, already guaranteed, these topics, they'll be in the exam. They'll be there. They'll be in the exam. You know, for the others, we normally say, for example, maybe if there was partnership, that other sitting, it might end up not having to come. So maybe they might end up having to change. And maybe in this case, bring in maybe what public sector, or maybe they bring in what financial statement analysis. But these ones, even me when I was doing CPA, it was a must they be in the exam. It was a must they be in the exam. And of course, you know, this particular topic, group accounts. So you can see it doesn't have that normal double entry that's like you are used to, for example, in financial accounting. So when you do it for the first time, you'll really experience that in this case, it is very heavy. And of course, when I was having to start, I already told you that in this case, if you've never concentrated in a financial reporting class, this one you need to be able to focus. Because the double entries that we end up having to do here, some of them, they even don't make sense to you. But that's how you end up having to treat them. They're not like, in this case, the familiar transactions you know of. For example, when you are doing them in financial accounting, NCI. So a very new term. You've never heard about it since you started learning about what financial accounting. Goodwill. The accounts about goodwill, you've never heard about it. When you started financial accounting, you never heard about them. But now you can see they're here. So practice will likely end up having to make what perfect. That was, I can be able to encourage you. I felt the same experience like you when I was having to do CPA. So I know what you're having to go through. Practice will make perfect. Practice will make perfect. So if you go through questions, try to review back. In any case, you come across a difficult area, you can be able to ask. You'll, in this case, grasp it more. And of course, you know, it doesn't end here, because in your advanced financial reporting, now they'll make it a bit complex. They'll make it a bit complex, whereby in this case, in the exam, they don't actually end up having to test what one subsidiary. They combine two subsidiaries and even what one associate. So you need to practice, 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 and I think that actually all will actually be well. That is what I can be able to encourage you. That is what I can be able to encourage you. And of course, in this case, you need to maintain highest level of confidence when you're having to, in this case, do what? Revise financial reporting. You will be able to pass. But if you start having to panic, that is like, I'm not having to understand anything, then that's where now the trouble comes in. That's where now the trouble comes in. So of course, the good thing with financial reporting, it is an idea of you having to make what? Entries. Entries. Certain entries, they don't need, in this case, what? Adjustments. Ideally, so long as you've gotten the entry from the question paper, some of them you just end up having to pass in the final accounts the way the figures are. So that's why I was having to say, you can't actually go into a financial reporting exam with the mentality that in this case, group accounts, I'll score 0. You can't score 0. If you are very smart, you can't score 0 in this case. There are those entries that don't need adjustments. You just pick them the way they are. And of course, you place them in the final accounts. You'll be able to score a mark. In fact, you'll score similar marks to, in this case, those ones you've done workings, because sometimes in this case, they end up having to award 2 marks for each and every correct entry. So there are those ones that don't need any form of adjustments, but you've coolly gotten what? Your 2 marks. Those ones you made a lot of adjustments, you ended up having to still do what? Score 2 marks. Score 2 marks. Then another thing, with this particular paper here, in the exam, start with the easiest questions. Start with the easiest questions. If you're not very keen, they'll be saying 30 minutes to go. You've only done 2 questions. Yet there are 5 questions to attempt. Start with the easiest questions. If you are very smart enough, maybe in theory, you can start with the theory questions very fast, very fast, very fast, very fast. Then you go to what? To the easiest questions. Never start with the most difficult question, because you'll be caught out with time. You'll be caught out with time. You'll be caught out with time. It's not a matter of you having to start with question number 1. No. Analyze. In this case, you've realized that they have brought published financial statements, but it's not looking that heavy. I can start with it. They have brought, in this case, what? Retirement benefits, which doesn't require complicated entries. Yes, quickly, very start with it. They have brought what? For example, financial statement analysis. Ratios, so long as I know a formula, I'm good to go. It doesn't need a lot of what? Adjustments. Just be able to put the entries there very fast. So always start with what? The easiest questions. The easiest questions. Don't start with the most difficult, or don't start with just question number 1. Don't just start with question number 1. So, in this case, having to pass an exam, you also need to be very strategic as you approach this CPA. It's not just a matter of having to get in. You get in with a strategy. You get in with a strategy. When you go to an exam, you get into the exam with a strategy, because you have to conquer this KASNEB. You have to conquer this KASNEB. You have to conquer this KASNEB. So that is what I can be able to encourage you. And I think if you try to practice here and there, you make a mistake. You make a mistake, you try, it is not balancing, you try to find out why is it not balancing. That's how you basically get to grasp more. You grasp more, you grasp more, you grasp more. And of course, in this case, practice ends up having to make what? Perfect. It ends up having to make perfect. It ends up having to make perfect. It ends up having to make perfect. So I can be able to see you asking for shortcuts. You're asking for what the best way of handling the question on cash flow during exams, bearing in mind the limited time, and there are shortcuts. So the problem now in this case with financial reporting, you'll have to do workings. You can see almost in all the topics we are doing workings. The only shortcut you have in this case, it is if you've already mastered those entries that don't need what? Adjustments. In fact, you can be able to prepare the cash flow as a skeleton. Then you fill out those entries that don't need adjustment. You place the figures there. Then in this case, you end up having to now do what? Deal with the workings. Deal with the workings. But almost in each and every topic, you can see you are doing workings. Published, you do workings first of all. But of course, there are those figures that don't have what? Workings. So if you are very smart, you know which ones. In this case, probably they never need workings, these ones. You can prepare a skeleton of the balance sheet and place them there very fast. Now, in this case, you start doing the workings. Then you place the figures, place the figures, place the figures. Then you try and in this case to do what? To add them, whether it is having to balance or not. Another thing, in the exam, if you done a question, you realize it's not balancing, don't waste your time trying to think how we need to balance. No, move to the next one. Move to the next one. Because they mark what? Entries. They mark entries. They don't actually focus you've been able to balance it. Where you'll score maximum marks, in this case, is having to do what? The entries. The entries. So if you've done a question is not balancing, don't even think about it again. Move to the next one. Go to the next one. Then when you finish is when you can come back. Then try to ask yourself, why was it not balancing? Where could have I made a mistake? Like that. Then you try to do what? To balance. But if you realize it's not balancing, you'll end up having to waste another 30 minutes. And you are going time. So that is what is actually very, very important. I don't know what 𝐷𝑃 is having to mean. So working, don't do the workings at the back. Do the workings where your answer is. Don't do the workings at the back. Sawa. Do the workings where you are putting the answer. Where you are putting the answer. Don't go at the back doing the workings. The examiner would like to know how are you having to arrive at your entries. So they are part of, in this case, what the answer. But for those workings, they don't actually, of course, you have no option. You'll have to do them so that you can get what you'd be able to place as an entry. You can't fail to do them. You have to do them. But I'm having to say, there are those figures they don't need workings. There are those ones that they don't need workings. Will you do a working for a figure that doesn't need a working? So you place them directly in the final account. But the ones that need workings, you have no option. You'll have to do the workings. You'll have to do the workings. You'll have to do the workings like that. You'll have to do the workings like that so that you can actually be able to place the figures there. They should come before. They should come before the final. They should come before. Just do the workings before you put what the final statements. Just before you put the final statements. They should come before you put what the final statements. So that is what is very important. That is what is very important. But even if you do them after or before, you know the examiner already knows. He's looking for the final statement. And of course, he knows the format. So you'd be able to know these are workings, these are now this is the final format the student has actually been able to present. But now in this case, the best option is to be able to do them first of all, like the way you can see I do them first, then I do the final accounts. Because I'm having to get the figures from the workings, then I place them in the final accounts like that. So you do them before you prepare the final statements. Before you prepare the final statements. I think that is very important. So let's meet tomorrow where we'll be able to start looking at the last two topics. For now, we can be able to start blocks. So for the theory part, I'll just take you through maybe one session or maybe two sessions, then I think it will actually be okay. But with these ones, I think by next week, we'll actually do public sector accounting, branch accounts. Okay. But if you feel like in this case, there's a part under computation which you haven't covered, you can go back to the syllabus, look whether there is any, and be able to reach out. But I think we've been able to cover all the computational areas that are required, apart from public sector accounting, and of course now in this case, maybe what branch accounts. So branch accounts, that is very important. Branch accounts, that is very important. So I think that's all. You can have a good night. So let's catch up tomorrow.